Hi everyone, and welcome to another episode of Value Investing Talks, where we discuss finance, business, and value investing. I'm your host Eugene Alexiev, and I bring with me over 10 plus years of experience in running my own businesses. Some of them were sold, and some of them I run nowadays. Additionally, I am the founder of numpfin.com, a comprehensive stock research tool for public companies. At Numpfin, we cover over 60,000 companies listed on 70 plus stock exchanges worldwide. Our platform provides information in 25 languages, offering insights into finance, management, company ratios, and other essential facts. You can find the link to our website in the description. It is also important to note that all the information shared on this podcast is intended for educational and entertainment purposes only. We do not provide financial advice. So sit back, relax, and let's dive into the world of investing. Hi everyone, and today our guest is Rahul.
Hi, Eugene. Thank you so much for having me. It's a great opportunity to be here and share my thoughts on value investing.
Could you please tell a little bit more about yourself, how you came up to this, where you are now?
Originally, I'm from Mumbai. I'm currently based in Berlin. So, in short, I'm a software engineer turned investment professional, right? And this journey has been really exciting. And so, growing up in a family deeply involved in the stock market, I developed a keen interest in understanding capital markets, right, at a very early age. So once I completed my engineering, by the end of it, that curiosity led me to a credit analyst role where I was looking at distressed companies in the US, and that's kind of interested me to move on in my career and face newer challenges. So eventually I landed up into institutional equity research, and that was the beginning of my value investing journey. I started understanding accounting standards better. I started tracking companies across oil and gas, telecom, internet sectors, and this basically gave me a steep learning curve to look at businesses and also from different lenses. So, one important learning journey I would like to highlight would be using the accounting quality checks, that I still use in my day to day investments, right? So, one can gauge accounting quality by relatively ranking companies on basis on a few ratios.
Speaking about accounting, I see that all the gurus of value investors in general, they tell that you need to know this type of thing in order to analyze and understand the companies better. How this help you? Is it really important to go and get this professional type of accounting degree or maybe education to better analyze and be better value investor? What do you think?
I would say, I mean, the function of research should not only be confined to, finding growth stocks and, winners all the time. That's what the whole market or even individual investors that do that. But our duty is also to identify dubious companies, right? And generally in emerging markets and in a market like India, we do notice that there has been a lot of companies who have tried to have these creative accounting methods to embezzle their money, right, from the shareholders. So it is important to have a nice accounting quality check to ensure that the company that you're investing in the long term with are at the right pace and they have a good management in place.
Are there any particular rules for accounting check or the particular company to prevent this investing in the companies with this creative accounting thing?
So I would like to share something that I used to use in my work at Ambit Capital, right? So there are a bunch of ratios which are for non-banking companies and for banking companies. So basically, there are four buckets of four categories, you could say, right? So the first category would be profit and loss misstatement check. The first ratio is cumulative CFO by cumulative EBITDA. These ratios have to be calculated over a period of 5 or 6 years, and this would basically help you identify if the company has been generating cash, and if the ratio is really low, which means that the company is not being converted to cash, or there is some aggressive techniques being used to pump up your EBITDA. And the other one would be in the PNL misstatements would be your volatility in your depreciation rate. Basically this gives gives the management the power to fudge your profitability. So they can basically decide the life of the assets essentially, by changing the depreciation rate. If this pattern is being found in companies, so you could identify that, there is something wrong with the company's management or in the company's account.
These indicators can affect the profitability and free cash flow of the company, right? And in this case, the valuation of this company can be lower, right? Or higher.
Exactly. So, I mean, the valuation would look very high because the profitability and everything looks good, but there is no cash that is flowing into the balance sheet. So that would basically, which the investor might overlook. They might just look at the profit and statements and they might see, okay, they are doing great EBITDAs and margins are great, and all of that. But the real cash conversion doesn't happen in the balance sheet, which is a very big negative. The next category would be your balance sheet checks. So the two key ratios that I used to see in my portfolio companies would be the cash yield. So basically, cash yield is nothing but your investment income by your current investments or your cash in. So a good example here would be Satyam Computers. They were one of the biggest scams in India, right, in the 90s, or I'm not sure.
Yeah.
Where the company reported low cash yields despite having significant cash on the books, right? In an emerging market, having returns as low as 2%, right, which is something that the company is not making proper use of cash. So, and the other one would be contingent liability as a proportion of net worth. So sometimes what happens is companies have a lot of contingent liabilities, right? But they shy away from making provisions or taking a hit on their profitability statements.
So it's like the long-term debt or what?
The most common contingent liability in India would be court cases, right? There are some legal proceedings that are pending, and you might have really big issues that are damaging your image or even your brand. And the companies need to have a provision for these contingent liabilities in the P&L statements, and which would kind of reduce their profitability, which the company don't do. And that's where the whole creative accounting and the auditors, they kind of get together. Next category, bill freight checks, stealing small amounts but for a continued period, it hurts the company very, very badly. Basically what you do is you look at consolidated numbers for the companies. The ratio that I would like to mention here at bill freight checks would be your miscellaneous expense as a percentage of revenue. Within other expenses, you have something called miscellaneous expenses. Sometimes the percentage is as high as 3 to 5% of your revenues. So, which is something that the company is, something hiding it from you. So, there is some movement of money which is not being openly shared to the shareholders, right? And if you're an investment analyst on the market, you can, on the street, I mean, you could probably ask the management, or you could question them on these things, right? And finally, would be your auditor checks. Growth of auditor remuneration to growth of consolidated revenues. If the growth of auditor remuneration is way more compared to the growth of the company's revenues, that the whole accounting is kind of not independent. There are some manipulations happening in order to keep the companies from blowing away.
Why do you think management does that? To attract more money or to mislead the shareholders somehow, to motivate them purchase the stock, or maybe other reason? Why do they do that?
So basically what happens is, in a growing phase, when the bull markets are happening, all investors are looking to have more money flow that they would want in their companies, right? That's the reason where the creative accounting comes, and eventually these would blow up in a declining market. So that's what promoters and auditors engage in to make that money and exit their position. Promoters are found being notorious in the Indian market. Basically, I do the normal way of researching, going through their annual reports and looking for projecting their numbers using DCF model. That's the normal way of finding their value and everything.
Do you use any particular tools for that, or you do it by hand, looking through the particular quarterly reports of the company?
So currently I run my own models, but for numbers would be Screener. There is Yahoo Finance, and and all the numbers that are being listed publicly in PSE and NSE websites. So that is the main source of data. There's no specific tool that I kind of use it. Probably going ahead, I would start using Numphin, right?
What other metrics are the most important for you as well? Because when you make the due diligence about the company, you have these indicators. What will you do next? Are you analyzing the particular management or maybe financials in the growth and the margins, and how does it work?
So my approach is like, I always create a DCF model on my companies, right? I need to project my revenues and I need to have my projections and I need to discount them. These are basically relative rankings. I would relatively rank my companies within the industry or within the whole sphere to see how if these key metrics are being followed, am I in a zone of safety or in a bad say zone where the companies that I'm holding in my portfolio or I'm looking into, where do they relatively stand in the whole spectrum?
So basically, you compare with the average of the industry, right?
Correct.
You also told that you analyze not only Indian companies but the worldwide. Are these things can be found on the established markets as well?
So, I mean, yes, you could use it obviously to check because the whole world is kind of coming towards a common accounting standards, and there are many different markets might have different ways of having a creative accounting, right? So it always have to have these good checks. Currently, I have not implemented. I have not very high exposure globally. These are good practices that you could have in your investment philosophy.
If you compare Indian or Asian market with the European or US, there are clear difference in laws with accounting thing as well. So basically, if you are a US company, the top management cannot provide the mislead information to the shareholders because the top management will be sued and can go to jail, have the fines, etc. So it's prohibited by law. Are there any similar types of laws in India which prohibit such type of creating accounting?
There are laws in place, and there is like a mediator like SEBI who keeps track of these numbers that the companies report. I mean, companies don't report fraud numbers. They would report in a different way. I mean, they would some expense that they cannot explain, or they must have used it to probably bribe some of their vendors or something. They might just show it as miscellaneous expenses, which is inside your other expenses, right? So they might just report it differently, which is very difficult for even normal investors or even institutional investors to catch these dubious reporting. So this is where we come. I mean, your quality checks would come into place in understanding. Okay, this is not something normal in the industry. You don't see it in other companies, but this one particular company has significant miscellaneous expenses as a percentage of revenue. So that keeps you. But the laws are in place. I mean, there are companies who get penalized for sharing misleading information, and it's improving. Yeah.
If you, for example, do not understand the number of particular type of numbers, and if you call to top management, will they openly share this maybe or disclose some information? Sometimes you can write to investor relations department in the US and they will answer your question. Does it work the same with the Indian companies?
Yes, sure. I mean, companies can refrain from not sharing the details, but most of the companies from our workplace, we used to reach out and get at the list of top 300 or 500, list of investors, which is not basically available, like in the US market. There are websites and there are providers who track these kind of data labels, but in the Indian market still it's you have to reach out to the companies, and yes, I would say companies are approachable and they do share information.
Speaking about the Indian companies in general, are there local peculiarities in the accounting if you compare to the general accounting rules, for example, in Europe or US?
So yeah, so the accounting followed there is something called Ind AS, right? India's accounting standard. But there are slight differences in terms of reporting in and classification. But I mean I wouldn't be the best person because I'm not a accountant. I wouldn't know
Okay.
the deep differences. It's not difficult for a person coming from the US to not understand the accounting standard. It's very similar, and I mean I've tracked companies who have IFRS reporting, and then I also worked in the Indian markets, right? So I didn't feel a big challenge to transition between accounting standards.
Yeah, I see. Could you please describe your investment style? Because we spoke before this podcast for some time, and could you please share maybe some ideas or insights? What are you heading to? So is it like the long-term holding, the concentrated portfolio, or how does it work in your way?
My whole knowledge doesn't come from one particular person or one particular style. I've been taking and absorbing knowledge from a collective of things, and and from people. My style still would be like I look for growth companies. I look for companies that have been in the market. I really don't like to test my investments on brand new companies who do not have like a lot of years in the market and who have not seen the business cycles. So, and I would say I like to keep my portfolio very concentrated, and as you rightly highlighted, I might clone like Monish Pabrai, right? I do have a kind of concentrated portfolio, but my investment horizons are really long.
Do you have any maybe personal indicators if you analyze the company, you understand that you will hold this company for a very long time. And if something changes, you might want to sell. Do you have any type of checklist of such type of situations?
One would be if there are any contingent liabilities that are not improving for the company. I would while investing, if I assume that this won't be a big problem in the future, and I do go back to my investment and keep checking and keep learning if how are things running for the companies, and if I believe that the things are going bad, and things are not improving for the companies, I would kind of try to ease my position on it. Like I would reduce my exposure towards that, and I would look for better investment opportunities.
So you just reduce the percentage of holding, right? Not selling the whole position.
Not completely sell at one go, because I would reduce my exposure first, and then probably reassess.
You analyzed the company and you understood that the appropriate level to acquire the stock should be like, I don't know, 100. And you acquired like some percentages of that. And then you see that the stock price will go even down. Will you improve the position in this case, or you just stick to this particular percentage which you had in the beginning?
I mean, I obviously follow the percentage. I know I don't follow the price. I have a thesis always in my place. I don't look at, I don't focus too much on the valuation. I do see when I enter, I do see if I'm buying it too expensive, or if I'm entering it right. But I don't go too much to time the market, or try go to average it later on. But just keep holding on to that stuff.
Do you have any pieces of advice to the person who just wants to know more about this due diligence of such type of companies or accounting stuff? Maybe some resources to look through and read and educate yourself. Maybe some books.
So I would recommend this book called Financial Shenanigans by Howard Schultz. Right, that's an amazing book that kind of teaches you how to look at accounting. It gives you a different lens at looking at accounts. We both come from a technological background, and I used to find accounting intimidating. This book kind of really changed my understanding and perspective about accounting and how to look at businesses. This is a great book. And my other favorite book would be Zero to One, which gives you the mindset to think, differently, and how you look at businesses that are going out of the way to make wealth for shareholders.
Thank you so much for your time and your valuable knowledge about the accounting, about all the principles. See you next time. That's all for today, guys. I hope you really enjoyed the episode and found it useful. Don't forget to subscribe for more. Check out nothing.com and see you next time.